welcome back. Business 150, Introduction to Management. We're still in our module looking at the topic of control. In the last video, we looked at that very crucial application of control in operations, operational control. And now we look at arguably the other primary place where you have to exercise managerial control. Where is that? You see here on the title screen, financial control. Financial control, essential and crucial. You cannot run a business without financial control. And therefore, we hope that at the end of this video, you will be able to describe the fundamental principles of financial control. So let's jump right in. Financial control. It is the most commonly used and basic methods of financial control. They include budgetary control, analysis of your financial statements, and financial audits. Financial control is the principal means of controlling the availability and the cost of your financial resources. All of these kinds of things are absolutely crucial to maintain profitability, to make sure that you are not subject to embezzlement or theft, that you have full control over financial performance. Now, one of the things that really makes this crucial is working based on a budget. Budgets are crucial to financial control. You know exactly what we're talking about, perhaps even from your personal financial life, right? Living with a budget leads to better coordination of organizational activities. It serves as a means of bringing together diverse members to determine overall objectives. And it implies a need for the organization to adapt continually in the face of constant environmental change. All of that's accomplished by running divisional, departmental, and overall organizational financial budgets. What's the disadvantage of working with organizational financial budgets? You see it here on the screen. It ain't easy. It's difficult and a negotiation process to be able to work through how much each department gets and where is our overall financial resources and how do we divide that up. It isn't easy. It takes experience, it takes know-how, and it takes interpersonal skill to work with departmental leaders to develop and get your budgets accepted. And it also often involves an extensive use of what we call incremental budgeting, right? To be able to work from period to period and really be able to help people accept where they're going. And it's sometimes used, quite frankly, as a method of legitimizing current power structures. You know exactly what I mean. The most important political divisions get larger budgets, sometimes whether they need them or not, but it's a show of power and influence to be able to command a larger budget. That's not really working in the same purposes as organizational goals. It's a means of flexing the ego and flexing influence. So sometimes budgets end up being political processes when they shouldn't be. That's one of the disadvantages of working with budgets. Now, when we talk about using budgets, we also need to talk about using financial statements. And this is sort of, the obvious domain of accounting classes when we talk about financial statements. But whether or not you ever take an accounting class or not, as a manager, you need to be aware of at least two primary principal financial statements, that being the balance sheet and the income statement. More of this in the textbook, but what we'll say here in this lecture, what is a balance sheet? A balance sheet is a snapshot, a point-in-time statement of what does the firm own in terms of assets, and who owns those assets? Are those assets owned by owner's equity, or are they financed with borrowed money? Are they, does someone have a claim on those things? More on this in the text. We'll say that for now. I would, of course, encourage you, if you really are serious about managing in your career, then you should be taking some introduction to financial accounting classes to really understand what is a balance sheet, how do you use it, read it, and interpret it. The second form of a financial statement that you'll need to understand in terms of managerial control is the income statement. What is an income statement? Unlike the balance sheet, which is a snapshot in a point in time, An income statement typically works and displays over a period of time, whether that's a month, a quarter, or an annual income statement, to display what is the revenue coming into an organization, as well as what are the costs associated with earning that revenue, and therefore what is the overall net income or profit that an organization has enjoyed over that period of time, to show whether or not you're making money or losing money. Those are the two primary financial statements that you'll need to become familiar with. And again, what we highly encourage you, and that I also teach in other places, Introduction to Financial Accounting, to get more familiar how to read, interpret, and analyze financial statements. And the primary way that we analyze financial statements is, you see here, what we call financial ratio analysis. That takes information, data, numbers from the balance sheet and income statement and uses those numbers in terms of ratios to measure a company's efficiency or profitability, or where the finances are coming from, what's the sources of capital used by an organization to produce revenue. So this is reproduced from your textbook. You can see here, table 15.2 in your text shows a couple of different types of ratios, shows liquidity ratios as well as solvency ratios, and provides some description of what those things are. Liquidity, of course, refers to, in a short-term basis, how liquid an organization is. In other words, what's the ability of an organization to pay its short-term debts. You can see there expressed there as both a current ratio and a quick ratio, and those things defined and described. And solvency refers to a company's long-term prospects of able to not only meet its obligations, but how well is it actually making money. So more on this in the textbook. I don't want to belabor this entire table in this lecture, but you will need to know, for the sake of an exam and a quiz coming to a theater near you, how does the liquidity and solvency ratio help you to analyze the financial health of an organization? So we hope that, at least as an introduction, you're able to see how financial control fits into the overall control process, and what are some of the basic tools we use as managers, right, to analyze and understand the health, efficiency, and profitability of typical organizations. Hope that's helpful. More on this in the textbook, and we'll see you in the next lecture.